Okay, we are live. Welcome to Boston Basic Income. I'm Alex Howlett. This week's topic is Debt Jubilee. So to what extent does it make sense to periodically forgive or restructure people's debt at a large scale across the whole economy? And that can be people and businesses. When debt gets out of hand, is this an appropriate response? So some of us read an article by Richard Vague entitled, "It's Time for a Debt Jubilee." So we know where he stands. And the article is long and it gets pretty complicated because once you start forgiving people's debts or relieving people's debts, then the question is, what about the people who are going to get paid that debt? And the question is, if people know that their debt is going to get forgiven, does that create a moral hazard where they're going to just get into debt because they know it doesn't have to be paid back in the end anyway? So there's all kinds of complications that have to do with it. So we're going to look at some quotes from this article, but first I want to go around and get people's initial thoughts on debt jubilee and how it relates to basic income. So with basic income, you're giving people money. So presumably they could, if they wanted to, use that money to pay down their debts or just to pay them back in the normal way, instead of having to say, okay, you don't have to pay your debt anymore or something like that. So let's go to Derek and then Richard and then Neil.
This really was a doozy of an article, so I'm looking forward to getting into it. I just, on the basic comparison of basic income to debt jubilee, I think people who've heard me talk before probably know where I stand on this. I mean, I think that to some extent, there's something the author sort of touches on briefly in this and didn't explore as much as I'd like to, which is that, people don't, if they have the money to pay off the debts, they tend not to acquire excessive debt in the first place. And so to me, if you can prevent a problem from occurring in the first place, that's usually the best way to solve a problem, because then it's not a problem again anymore. There's other solutions where you'd have to go after the fact and address it once, but if you didn't sort of solve what was causing it in the first place, you'll have to address it again and again and again. And so, I mean, I also, just as a footnote, would like to, and you can sort of tell from this article, like just how key the concept of debt is to money in general and to the economy in general. It's such like a core thing that I can't really anymore say that like private debt itself is a problem, and like I think that there's any understanding of sort of reducing the pain pressure of debt for people, for consumers, has to be done in the context of understanding what useful role private debt does serve in the economy. So we want to just keep that in mind. And I think basic income is right there in the middle, where it solves both problems really well. It allows private debt to accumulate in a healthy way, but it also allows people to pay off their debts, but also, more importantly, avoid accumulating excessive private debt in the first place.
Yeah, good stuff. It's an interesting question. If we periodically have to press the reset button on everybody's private debt, is that a sign that maybe there's something deeper that's wrong that can be addressed, perhaps through basic income? Let's go to Richard and then Neil and then Bethany.
Well, in the article, they state that it's unfair that some people are able to pay off their debt or never have debt in the first place, while others don't use their money wisely or accumulate debt. So if everyone receives like a basic income or $10,000 or something like that, they can use it however they wish, and which would mean that they could either pay off debt, or they can use it to buy things, or they can save it for that matter. So
yeah, I think that's a really good point, and that's related to the moral hazard thing too. Now you're punishing people for doing the right thing, which creates an incentive to maybe borrow more or something like that, or you're punishing people for being responsible. Let's go to Neil and then Bethany and then Joan.
To me, it's the bankruptcy laws are sort of a compromise between a jubilee and never doing anything. And you could modify the bankruptcy laws however you think you want, so that it approaches a jubilee. I don't think that's a good idea, but you could argue that way. What was the other part? I also, okay, I forgot my other train of thought, so I'll get back to it sometime.
Okay, sounds good. Let's go to, well, I guess we're going to skip Bethany for now because she's still getting set up. Let's go to Joan and then Elizabeth and then Eddie.
Yeah, hi. I didn't have a chance to read the article, but I'm looking forward to the discussion and the quotes and whatnot. Yep.
Okay, great. Let's go to Elizabeth, Eddie, and then Austin.
Yeah, I did not manage to get very far in this 42-minute read. I was like, oh, yeah, I'll read it on my lunch break, and then that didn't happen. Given the world that we live in without basic income, I really like the idea of a debt jubilee. So I'm really interested to hear about some of the highlights of the complications of that. I mean, as people have pointed out earlier, if we're in a situation where a debt jubilee is a thing that we need to do, that feels like the system isn't working appropriately. So I think like a basic income such that people can manage the debt that they have seems like a much more sustainable solution than being like, okay, let's just start over. But if our options are debt jubilee or nothing, I would, my instinct is I'm like, okay, we could just forgive people's debt. Feels like a thing that we could afford to do, even while I recognize that that is not the most sustainable of all the possible options available to us.
Yeah, I think that's a very pragmatic way to look at it, and I like that. Let's go to Eddie, Austin, and then Bethany. Where are you, Eddie? Wait, oh yeah, there he is.
Things I agreed with the article about. One is he mentioned UBI somewhere in there, and I agree with the monetary UBI. Another thing is that the economy could probably use more stimulation right now. I agree with that. There were many things I disagreed with on the article. I think from the perspective of getting a theoretical understanding of what's really going on in the economy, there's many problems. One of the problems is that he feels that Fed money is debt-based money. And that is true on a technical basis, but in reality and in any practical sense, Fed money is really not debt. It's not a promise of anything else. The other point that he makes that I disagree with is that government debt doesn't matter, and I think government debt does potentially matter. It doesn't. It depends, but you can't just say that it doesn't matter. Two things that I want to point out. One is the credit cycle. So this idea that the Great Depression and depressions are caused by the credit cycle. This is quite a common idea. And I put that in the same basket as Keynes's paradox of thrift. I think that it is definitely a factor, but I don't think it is the initiating factor. I don't think it's the initiating factor. And the other point that I want to make, which I think is very important for understanding all this, is that the other name for a debt is an asset. That's true of all debts. All debts are also assets. And so when you say that debt is increasing more and more, you can also say that assets are increasing more and more, because the debt has a borrower and a lender. So it's always a debt for the borrower, but it's always also an asset for the lender. So that's all I'll say for now. Yeah. Lots
Great.
to get into. Yeah.
Yeah, thanks, Eddie. So maybe what you're getting at is that the accumulation of private debt in the economy is maybe not as dangerous or scary as people make it out to be when they kind of blame the recessions on the kind of like the collapse of debt and that kind of thing. So let's go to Austin, Bethany, and then Kayauna, if I'm pronouncing that correctly.
Hey guys, I haven't read the article, I'm afraid, but I am familiar with Steve Keen's work, which is all about the role of private debt in the economy. So I guess he's convinced me pretty much that I'm not sure how much this goes against what Eddie and you were just saying, but that actually, you know, that the private debt to GDP ratio is a really good predictor of problems in the economy. That and that actually that when the private debt when the economy is growing, the way we have things set up now, it almost always involves a growth in private debt to GDP ratio, and then when there's a collapse, that goes into reverse. And that when everybody's paying off their debts and no one's taking on new ones, that necessarily shrinks the flow of money into the economy and increases the flow out of the economy. So that's something I find quite convincing, just because he points out these really strong correlations between one thing and the other. His solution has been previously a debt jubilee accompanied by cash payments to people who don't have debt. So, you know, everyone gets $20,000 or whatever. And if you're $20,000 in debt, that goes immediately to pay off your debts. If you have no debt, you get $20,000 in cash. And, you know, so therefore that would avoid, he thinks, the moral hazard. But it still seems like a fairly clumsy instrument. I think that a basic income is probably, that a basic income combined with other policies is probably better. So that would include especially interventions in the housing market, because the so much debt is mortgage debt and is to do with people trying to acquire housing, and you have these asset bubbles that occur where everyone wants to get into the housing market. So that makes it a really good investment. So everybody wants to get into the housing market. So that makes it a really good investment. And prices go up and up and up. And that's the problem in Australia. And that to me is a really bizarre thing, because you constantly see news headlines saying, good news, house prices went up. And it's like, why is it good news that living in a house just became more expensive? Surely it would be good news if houses were cheap, right? But anyhow, so I think that the debt problem is that there is a problem with too much private debt, and that you probably want to come at that from multiple angles. I think some kind of debt forgiveness. I know in the US you have absurd student debt problems, and maybe like if there was a massive correction in the housing market. So say the government took my perspective and said, wait a minute, we actually want housing to be cheap. We don't want it to be expensive. And built a lot of public housing and did something to lower house prices, then you might find there are all these people who are underwater with houses worth less than what they owe as a mortgage. In that scenario, you might want, I think, to do specific debt reductions, or if there's, you know, we might say, okay, the system's been dysfunctional till now, let's have some kind of jubilee and hit reset. But I don't think it makes sense to have it as like a part of normal recurring policy. I think what Derek said is right, that you'd want to prevent the debt from building up, and you might do that by looking at limiting stopping the debt from being created in the first place, regulating the volume or the kind of loans that can be made, all of that kind of stuff at the upstream level, rather than coming in after the fact and saying, okay, let's just wipe let's wipe the slate clean on a recurring basis. So I'm skeptical about the Steve Keen is someone I'm very impressed by, and he sort of saw the debt jubilee, especially I know a decade or two ago when he first started writing about it. It was he kept coming back to it again and again as the solution to all our ills, because debt was this. Debt was this private debt was this towering problem that no one was paying attention to, is the way he put it, as opposed to public debt, which wasn't so bad, but everyone's concerned about. So I think that want to have. I don't think it's a sort of a big one size fits all solution that you can keep coming back to. I think that there'd be some limited role for debt forgiveness.
Okay, fantastic. Let's go to Bethany.
Hi. Okay. So I think people said many of the things I would say, but I agree very much with Derek that it does seem like a sign of an underlying problem if you're kind of constantly building up debt and then needing to forgive it. And I also seems like a problematic solution in the sense that you're then creating strange incentives to take on debt and then have it be forgiven. Or if instead, like Austin was saying, you just give everybody money every once in a while, that's kind of like a basic income, that goes to some people's debts automatically, but only comes every once in a while. And so at that point, I think it's better to have like a more smooth distribution of whatever that money is. So I think I'm just reiterating what people have said, but I agree with all of those points. I also like Neil's point about bankruptcy, because in a sense, we do have some recourse for debt, at least some debts. I think college loans are not allowed to be part of that, but we could also think about whether we'd want to reform that as an additional step. I like that point. Thanks.
Yeah, I think, there's a common theme here, which is that we all look at the economy and we say, well, if you have an economy where this thing inevitably gets worse and worse and worse, and then you have to like periodically fix it. It's like, I don't know, it's like your car is leaking oil and you periodically have to top it off or something like that. It's not it doesn't fix the underlying problem. It's just kind of a way to keep going, despite the fact that something is broken. And that's my intuition as well. And then there's also the question of, if we're in the world we're in now, and then we're looking at an ideal world with something like a basic income in place, where maybe the value of houses goes way down, like Austin brought up, you can compare two states of the world, like the state of the world now and the state of the ideal state of the world. And you can make those comparisons and you can say, well, this is going to be better than how we have it now or something like that. But then you can also ask the question, what does the transition look like? And I think this is kind of what Austin was getting at, is that you might want to have some measures in place that help the transition be a little bit smoother. And I also want to point out, Eddie brought up that maybe Richard Vague, the author of the article, doesn't really care about government debt and thinks that government debt doesn't matter. If you get to the end of the article, he actually does say that government debt matters, and he has a whole part about how to reduce government debt by issuing debt-free money and that kind of stuff. So we'll get into that too. I actually disagree with both Eddie and Richard on that point. I don't think there's such a thing as debt-free money. But let's go to Neil.
Thank you. I just wanted to say the fact that recently we've had a basic income. The government printed checks to most people, and the effect was that people saved. So that is interesting. I think that's an interesting fact to consider. So people were worried about their debt, and they saved. So interesting.
Yeah, I think it is interesting to consider, and it's even interesting to consider because some people say that that's a problem. They're worried, oh no, people aren't spending their money and getting the economy going and stuff like that. But I think that it's not a problem if people save. If people save, that just means you could give them even more money if you wanted to, and then maybe they'll spend some of that or something. But yeah, I don't think it's a problem that people save, and I don't think it's a problem if they chose not to save either, or if they chose to pay down their debts. I mean, it's all a matter of, this is how people spend their money, how they spend it, and we can adjust how much money we give people based on what the economy can handle and that kind of thing. Let's go to Derek. Whoops, here we go.
Yeah, there's a phrase Alex sometimes uses, which is that I sort of picked up on. There's a difference between knowing something and internalizing it, like really knowing it. And I think there's a lot that this author is aware of and realizes that is actually really interesting and really, really clever. I think is really correct. Like he points out that like when people talk about growing out of the debt, there's kind of this shell game that's played where you take it out of one bucket, you put it in the other, right? So it's like, well, either private debt is growing or public sector debt is growing. And that's a really important point. And it would actually, I think, back up Alex's point, where it's like, well, there isn't such a thing, or is there such a thing as debt-free money, right? Like it's all someone's debt somewhere. But then at the same time, the author ends up, he's still emphasizing and I think similar maybe to Steve Keen a little bit, in that they're emphasizing the crushing size of private debt, and private debt is too big. Well, okay, is it too big and relative to what? So we could come up with these measures like ratio to GDP, but really what the problem is that people can't pay their debts. So people are taking on debts they can't pay, and they can't make the payment, right? So, and this is really different. It's really different saying that versus saying, well, the debt's just too large. I actually think it's really, really similar to the mistake people make with the government debt, where they emphasize, oh no, government debt's growing. And we all sort of forget that, like, the debt has to grow. If you're a really wealthy, rich person, right, usually you can take on what would seem like an absurd amount of debt to a poor person, but you can pay it off because your income stream is bigger, right? So, there's a big difference, I think, and because he's emphasizing the problem of debt as opposed to the problem of not being able to pay, and not having the means of making a payment, he ends up in these situations towards the end where he's coming up with policy that's actually designed to reduce the debt. And he'll even go so far as to say we should create money. We should create new government money that's debt-free money so we can reduce this number. But, it's true you could do that. And maybe we should reframe how we talk about total debt and things like that. But at the end of the day, what matters is that people can make their payments, right? That people are liquid. And so, anyway, this is stuff that occurs to me reading it.
Yeah, I like those thoughts. And I think it's people taking out debts they can't pay, and then also people paying their debts because they have to, and then they can't pay for other things that they might have wanted to pay for in the economy. So that's kind of like the debt overhang problem. So we're going to get to a quote from the article. Here we go. Economic life as we know it simply would not be possible without enormous amounts of private debt. It's like water, indispensable, always there and taken for granted and unnoticed except when there is dangerously too much or too little of it. People use debt to purchase cars, houses, and other major assets. Businesses such as supermarkets and retailers regularly use debt for their ongoing need to stock inventory. A manufacturer incurs debt to buy raw materials to turn into finished goods. So I think this is right. There's always a role for private debt. And if you eliminate it, then the economy can't really do what it's supposed to do, because people's payments and, are not always going to line up in time, and they might have to borrow for a period of time. And then, it had the ability to have debt in the economy facilitates smooth trade. But there's also this problem of it accumulating kind of forever. And the question is that an inevitable part of the economy? Is that inevitable to how the economy works? And I think the answer to that is no. And I think Richard Vague thinks the answer to that is no as well. But he's acknowledging that there is this role for private debt. So let's go to Austin.
Okay, kind of responding to what that was just there, and also just kind of responding to what Derek was saying, because Derek mentioned Steve Keen and then said, okay, but the problem is people can't repay their debts. I think we need to be really careful about the language, because the problem isn't that people as individuals can't repay their debts. It's the problem that people as a whole, the people, can't repay their debts, right? And we don't want to be falling into the trap of seeing a structural fact of the economy as the product of individual decisions, right? Of people not living within their means. And I don't think Derek thinks that. I just think it's interesting. We with the language around it is difficult. And I also wonder about the debt-free money thing, right? I know I've used with you the example of, okay, during the Second World War, the German government had this plan to attack the pound, the British pound, by counterfeiting it and dropping it in towns. And the idea was to create a panic, and there'd be inflation and no one would trust the British pound because they'd know it was being counterfeited. And the plan was abandoned because they just ended up using the money to buy stuff, right? Like they just need what they counterfeited the money. Then they're like, wait a minute, let's just use this to buy like steel or whatever for our armaments, right? And to me, that's an example, like counterfeiting or printing $1 trillion coin. These seem to me to be examples of debt-free creation of money. Like it's as a conceptual idea, you use the actual creation of a minting or printing of physical money, and then that just gets circulated in the economy, and there's no corresponding debt created. I know this is what Jeff Crocker says. I know in a previous discussion we've also talked about what you were saying. Well, there's no difference between whether we create the money without the debt up front, or whether we create it as a debt and then the Federal Reserve buys the debt and puts it on a shelf and doesn't care about it. And I sent that to a friend of mine who's more familiar with Crocker's work, and he said that no, in his book, Crocker sort of addresses that and says that there is an issue. So creating sovereign money is different. Sovereign money, as he calls it, is different to that. I don't know what that is, but I mean, I guess the idea of interest payments, or I'd like to. This to me seems like a slight difference there might be more important than it seems at first, because it's in a very central place in the economy and might have flow-on effects all throughout. Yeah.
Okay, well, definitely send me whatever your friend wrote, because that sounds very interesting. I would say that, for the example of counterfeiting, it's still, what you're doing is you're essentially committing fraud. You're making a promise on behalf of the government. It's like you signed something saying, I owe you $50, Bill Gates or something like that. That's the equivalent of counterfeiting. So you're making a promise on the government's behalf, and you're basically pretending to write an IOU on the government's behalf. It's a form of debt. It's a form of fraudulent debt, but it's still a form of debt. And if it's interchangeable with all the other money tokens that are out there circulating in the economy, then you can't really tell the difference, and the government still has to make good on that promise. It's still a government obligation to keep the purchasing power of the money stable. So let's go to another quote from the article. This huge debt overhang portends an extended period of stagnant and ever slower economic growth, with falling living standards for millions of debt-burdened households. This is not another broadside against government spending and call for austerity. Far from it. It is a call to unburden American households mired in debt. So this is the idea of the debt overhang. So we are certainly, when the debt is being created, that's giving people more money to spend, but then the obligation that comes with it kind of catches up with you later, and then it has the opposite effect of reducing spending. But that's only really true if you're trying to pay down the debt, if you're trying to reduce the total amount of debt, other than by forgiving it or something like that. If you're continually rolling over the debt and adding to it, then that perpetual growth of debt is going to continue to fuel more and more spending. Let's go to Derek.
Yeah, I mean, I think that's interesting to consider as well, because your tolerance level for debt overhang will vary based on your needs and your income and all that stuff. And so, I mean, something else he talks about here is he talks about, well, so he's talking about declining living standards alongside ballooning debt. And yeah, I'm now thinking about this section. And so I raised my hand for something earlier before, which I've forgotten about. So move on for me. You can come back to me later.
Okay, sounds good. Let's go to Eddie.
So the previous quote about the function of debt, I think that, I mean, hypothetically, if you had a society where people, like, it was a big stigma to lend and also a big stigma to borrow, you could still have an economy that's perfectly functional without debt. But I think debt is a very common, very fundamental, contract within the economy. And I actually have a different way. There are many economists who will say that, for instance, bank lending creates more money And I mean, I think it's actually it's kind of a definition thing. It's kind of, you could say that, and it's kind of a terms thing, but it's also kind of a framing thing, like what perspective do you want to look at it from? So the perspective that I like to look at it is that the base money, which currently is Federal Reserve money, and previously under the gold standard was the gold base. That's money. And when you have debt, you have a borrower and a lender. What's happening is that the lender has money that they don't want to spend. The borrower doesn't have money that they do want to spend right now, and the two exchange. The lender gives the money to the borrower to spend currently, so that the lender's money actually gets spent. So I actually view it as a increase in the velocity of money. Debt is an institution that allows money that belongs to savers everywhere to just run about, and it gets lent and invested again and again. So it allows the savers money to kind of increase its velocity and go over to some borrower somewhere else who wants to spend it right now, and it allows it to be spent, even though the saver himself, if he did not have this available, he would maybe just leave it with the goldsmith or put it under his mattress, and it would just sit there stagnant.
Yeah, I mean, I think that's right. Depending on where you draw the line between what counts as money and what counts as credit, if you draw that line, at a certain level, and then on the credit side of there's a vast expansion, then you can kind of chalk that up to an increased velocity in the money that underlies it, that backs up that credit. If you draw the line somewhere else, then the velocity is going to be different, and then the quantity of money is going to be different too. So I tend not to worry too much about these things, because where you draw that line is somewhat arbitrary. Even base money is a liability of the central bank. It's credit issued by the central bank. The central bank is a bank. It's not really that special as far as banks go, except that it's issuing the base money of the economy as its liability, and we're using that as our base money. Let's go to Derek.
Okay. Yeah, I think that kind of brings me back around on it. So I mean, I think what Alex just says there is really important. And yeah, it does depend on your perspective. But if you're saying, like, at some level, and if you're just accepting that most of what all money is debt, just like as a starting point, it's a type of debt, it's a special kind of debt. That really just changes your perspective on the whole thing, because in exactly the same way that the government is right, that a bank is saying, hey, look, I owe you this payment. I owe you $20, if you come collect it at some point. Well, we just think of that as money. It's just the bank just owes us money. That's all it is. The bank owes us. And if you think about currency and the sort of wider promise of currency, that's the government doing the same thing. Like they're just issuing the promise kind of on behalf of the whole thing, the whole economy. And they're saying the economy owes you $20 worth of stuff. And so, like, there is this, obviously, what makes the debt money is the fact that it's being made by someone who's way more reliable at paying their debts than you, at managing their debts than you, right? So I'm not going to accept, Eddie or Bethany's IOU and pay someone at the store, but they will accept the government's IOU or Bank of America's IOU. And once we understand that, I think we can simplify the problem and just say, well, what's the best way to distribute this special debt and manage the debt in the economy? How much of it can be done by just one big bank, which in our case will be the government up at the tippy top? And then maybe is it useful to have a bunch of smaller little mini governments or larger banks, depending on your perspective, also, pumping some new liquidity into the system here and there as the market kind of demands a bunch of it for a business or something. And I would say, yeah, that's important. That's useful. It's just that, like, the main thing that we need these IOUs for is for people to buy goods from the businesses. And the government could probably be handling most of that. Theoretically, the government could handle all of that. The government could just be one big bank. and they're the ones that issue these IOUs into the economy, and then we trade with them and build things with them, and that would be fine. And so it's this question of like, how much private debt do we need? How much private debting do we need as an activity, as a rolling activity? And I just think probably less than what we have. The government can promise us more goods available, and we'll be okay. We'll be okay with that structure of debt.
Yeah, I like that. Perry Merling says all banking is a swap of IOUs. And one of the most important swaps of IOUs is that you go to the bank and say, I owe you $10,000. And then the bank says, well, I owe you $10,000. But the debt that the bank owes to you, that's deposits. That's money that you can spend into the economy. So the banks transform less widely accepted debt into more widely accepted debt. And that's how debt becomes money. And that's the same with the central bank and government debt, right? Like the government, the central bank, the Fed buys up Treasury securities and gives you liabilities of the Federal Reserve. So you're swapping one liability for a more widely accepted liability. So the base money of the economy is kind of the liability or the debt that sits on top of this entire debt hierarchy. So let's go back to the article again. This is the vicious dynamic at the heart of middle America's financial distress. Higher debt curbs spending, which constrains growth. Constrained growth suppresses wages. Lower wages constrain spending further. So I picked this quote because it's interesting that wages are part of the cycle here. If you have basic income, none of this is going to cause people's incomes to go down. Constrained growth is not going to suppress the basic income, and it's not going to constrain spending further. So you don't have the vicious cycle. You might have the first step of maybe there's some financial distress and higher debt curb spending, which maybe constrains growth on one level, but there's some of people's spending is going to be funded directly by the basic income. Let's go to Neil.
I just wanted to point out that there's a big argument going on, about whether the Federal Reserve could increase its balance sheet tremendously, which means basically they print money. They don't say it's no longer being, they pay interest to themselves. What's that about? So the argument is that it matters that you cannot have you cannot run up its balance sheet forever, because that will lead to inflation. The counter argument is, look at Japan in the last 20 years, and basically they've been doing that, and there is no inflation. There's very low inflation. Look at us. The Fed's increasing its balance sheet gigantically. No inflation. So the counter argument is, as long as there's more productive capacity than we are spending, than the amount of people want, you can just give people money. You can just, the Federal Reserve can just keep increasing its balance sheet, and there will not be necessarily inflation. And so this is I've heard Federal Reserve people who insist this can't be so, and I've heard people say, well, what's Japan? What's this all about? So that's a very interesting argument. I have no answer for whether it's true or not, because I haven't lived for 1,000 years. But that I find that very interesting.
Yeah, I mean, I think that is a good point, and we can kind of reconcile the two sides of this: the side that says, the Fed can keep expanding its balance sheet forever, and then the side that says, no, you can't do that; it'll cause inflation. You can just say, well, the Fed can expand its balance sheet as long as it wants forever, subject to the constraint of inflation. And I think a lot of people, when they think about money in the economy, they think there's a certain amount of it that just keeps circulating. So then the intuition there is that once you get to the right amount, the Fed has to stop expanding its balance sheet, stop creating more money. But that's not really how I think about it. I think about money as flowing through the economy, and the economy needs a constant stream of new money flowing into it. So that means there needs to be a constant rate of expansion of the balance sheet of the Fed or expansion of debt somewhere. It can be private debt. And historically, we've seen that a lot of it is private debt because the Fed doesn't want to expand their balance sheet. And I think that's where a lot of these problems are coming from. But if we want to keep private debt at a manageable level, that would mean the Fed's balance sheet would have to keep growing forever, but at the right rate. If it grows too fast, then you get inflation. If it grows too slow, then you get too much expansion of private debt. So I would say that that's kind of where the trade-off is. Let's go to Austin.
I agree with what the article said about how you have this sort of vicious cycle. But I also agree with what Alex said about identifying wages as the point where we could sort of intervene in that cycle and complement wages with the UBI. Whereas they seem sort of stuck with the idea that wages have to be how you get people money, which I think Alex has convinced me that is pretty much the dead end that we keep hitting in economic discourse. Which is where he's very similar to Jeff Crocker, but disagrees about the sovereign money thing, right? But which goes back to, and I also agree with the Japan analogy. That's what Steve Keen constantly talks about. He says the world economy is turning Japanese. They just got there first, and that's where all the other developed economies are headed. So they're headed for this trap of low inflation, of deflationary pressure, right? But what I want to jump back to what Eddie and Derek said, and I think that there's what Steve Keen, and I'm convinced this is pretty much correct, would say is that picturing banking as borrowers lend as patient savers lending to impatient borrowers is actually wrong, and that you have to look at banks as creating money, not just the Fed, but private banks, that they actually just, make it up and write it on their balance sheets. They enter the deposits and the balances at once. And so that's fundamentally different. And it's a matter of loans preceding deposits, not deposits preceding loans. And that's why you can look at debt as this key sort of driver and indicator in the economy. And I think that also relates to this thing about, saying money is debt, misses something, because it's never a one-to-one. It's never a one-to-one relationship. So when the bank loans you $10,000, let's say if we start with the loan rather than the deposit, the bank loans you $10,000 the next day, and they put that in your savings account. The next day you might have $10,001 in your savings account because you've got a little bit of interest on that, but then you've got $10,002 in what you owe the bank. So there's already a mismatch, right? There's already a mismatch. It's not a one-to-one relationship. The debt and the credit or the money are not identical, and that's why I talked about the inflation example, the counterfeiting example earlier, and I think you had an answer for that. Well, that's fraud, right? Sure, but that doesn't. But what if it wasn't, right? So what if they print memorial coins? Okay, so that's an example that's not fraud. The government's doing it, or the government's defrauding itself, and it's printing a special coin, or it's or the example I used that when I went and saw a doctor the other day in Australia, that gets paid for by the Reserve Bank. The Reserve Bank writes a check to the doctor. Right. I don't think that the Reserve Bank then goes and says, okay, write somewhere that we owe ourselves this. And if they do, it doesn't really matter. So I think that it's money and debt are intimately related, but they're not identical. Or, the credit and the debt are two sides of the money, and you've got to keep your eye on the difference between the two of them, which is kind of what this article is about, because it's the difference between the money that people have, which was created by the loans, and the money that they owe, which is, the cost of those loans. And that always, and what Steve Keen points out is that always, the debt always overtakes the credit unless there's some kind of government intervention.
Yeah, well, a few points here. I think one thing to keep in mind is that when you borrow from the bank, the bank is also borrowing from you. Like, it's debt in both directions. The deposits are debt that the bank owes to you, and then the loan is debt that you owe to the bank. And it's true that, you know, one of these forms of debt is more valuable, more handy to have in your pocket than the other. I can't go to the grocery store and say, I owe you $10,000 and buy $10,000 worth of, you know, bread or something like that. But I can go to the bank and say, I owe you $10,000, and they'll give me $10,000 in deposits. So I pay the bank for that service. So I do have to pay them back more money than I get out. And that dynamic is true, but it's not true that one of these things is debt and the other one isn't. Well, depending on where you're standing in the hierarchy, some things might look like money and then some things might look like debt. So to me, my bank deposits look like money because I can go out and spend them in the economy. To the bank, my bank deposits look like credit, and reserves at the Fed look like money, right? So it kind of depends on your perspective, but it's the same mechanism either way. And then also, Austin, you brought up the point of it's not patient savers and impatient borrowers, or it's less like that, and it's more like creating money. And I would say that it's the same thing, right? So creating money is the same thing as lining up patient savers with impatient borrowers, because what you're doing is you're transforming the liability of the borrower into a more convenient liability, right? And that's how money is created. So the impatient borrower is transforming his IOUs into IOUs that everyone else in the economy is willing to trade or willing to accept as payment. So creating money and lining up savers with borrowers, there are two ways of kind of describing the same mechanism. You might use one to describe some cases more than others and that kind of thing, but it's still the same basic mechanism. It's a swap of IOUs. So let's go to the article again. A growing list of politicians and economists have been advocating various large-scale forms of debt restructuring, and the pandemic has only amplified their message. Presidential candidate Bernie Sanders, for one, called for outright forgiveness for all student debt. There have also been calls, especially in the immediate aftermath of the Great Recession, for mortgage debt relief and the latitude to modify mortgages from such economists as Joseph Stiglitz and Mark Zandi. But these recommendations have not been widely embraced and have engendered uneasiness and opposition based on three main objections: fairness, cost, and the moral hazard that debt forgiveness might create. So I think a lot of this has to do with the fact that you're targeting specific debts and forgiving them. And even if you're saying we're going to forgive all debts, some people are more debtors than others. And, you know, that creates, I think the fairness issue and the moral hazard issue are really the same issue, right? The idea that, oh, I didn't go into debt, so I don't get the relief, you know, that's an incentive problem. The reason why we have this sense of fairness in the first place is to create an incentive to kind of play by the rules or to do things properly, right? That's why we think things are fair. So moral hazard and fairness, I would say, are actually kind of the same problem here. But let's close this and go to Eddie.
So I really like that we're talking about money and debt and looking at the similarities and differences there. There's an example that's very instructive to think about, which is that prior to the Great Depression, we were on the gold standard. So gold was the base money, and at the time there was a period of time where it was private banking, and private banks all around the U.S. they would issue their own banknotes, and these banknotes that they issued would be a promise of the base money, a promise of gold. And so they'd issue the note, and you could bring your gold to the bank and have a place to store it, and they would give you a banknote for $100 worth of gold. And you could take that banknote, and this banknote is very interesting because it's a little bit like money, it's a little bit like debt. And one of the properties of debt, of standard debt, is that there's a borrower and a lender. And so this banknote, if you think about it, it has a borrower. The borrower is the bank, because the bank is borrowing your gold, but the lender is not written on the banknote. So the bank gives it to you, but they don't write your name on it. It doesn't say Eddie Chu's banknote of Iowa Bank. It's got no name on it. So so you can take that banknote and you can spend it in the economy. It's when you owe somebody, when you have to settle payments, you want to buy something from someone, you can hand that banknote to them. They'll look at it. Okay, it's an Iowa banknote, and then if they want that gold, they can take it to the bank and get the gold, or more likely they'll do the same thing. They'll spend it on. So this is it's like in between money and debt. There's a borrower, but there's no lender. I think the best analogy here for the base. So then what happens is we leave the gold standard. Prior to leaving the gold standard, the gold is the base money, and the central bank is also just a bank. They cannot create more base money. They can only promise that I will. They can only create promises. They can only create debts like the private banknotes where they give you a piece of paper and say, I promise that I'll give you $100 of gold sometime in the future when you come look for it. We leave the bank standard, and that makes the current world very interesting, because now we're on fiat money, and the money is no longer a promise of gold. So, not being a promise of gold, it is the monetary base itself. And so, for instance, we're talking about treasuries and Fed Reserve notes. Those are different because the treasuries, they still have a name on it. The treasuries are, and the name means something in terms of, if you have $1,000 treasury note and you're like, where do I get my money? You wait till it matures, and then you go to the US government to get your money. They'll give you Federal Reserve notes somehow. But if you look at your Federal Reserve notes, nobody takes the Federal Reserve notes to the Federal Reserve and says, give me my money. They say that is the money. You can exchange it for another one if you want, but that's the money. That's what you have. So yeah. It makes them sort of like the banker in Monopoly. It makes them sort of like the judge of the system, and not a player in the system. And so it's ripe for abuse. If they were, if the Fed Reserve was a profit maximizing organization, then, to make the most profit, just print lots of banknotes. That would maximize your profit, but that would, crash the system. So that is.
Yeah, I mean, I think these are great points. And a question we can ask ourselves is, what is the promise behind fiat money? What is the promise that the government is making? So I like that you brought up the example of the gold standard, because there it's obvious. The government is promising to give you a certain amount of gold when you redeem your dollar for it, right? Now you could have a gold standard where the government is merely promising to keep the market value of gold stable. So they're not going to give you the gold themselves, but they're promising that if you go out into the market, you'll be able to buy exactly this amount of gold with $1. You'll be able to buy exactly, 32 ounces of gold or whatever it used to be. I think that's a little high. But yeah, so it's still, of course, a liability of the government, and it's still, of course, a form of debt in the government. It's just they're making this promise, and it's up to and they're making sure that the economy is going to make good on the promise. They're making sure that the market is going to make good on the promise. So when you get to fiat money, it's a similar type of promise, except instead of promising that you can redeem a certain amount of gold for your money, they're promising that you can redeem a certain amount of consumer goods. There's a basket of consumer goods that they use to set the consumer price index. So it's still a promise in the same sense, and it's still a debt of the government in the same sense. The government has to back up this debt. It's just a little bit more abstract. But if you think about it, the reason we used gold in the first place as our base money was because it did have a fairly stable price with respect to consumer goods. Now, maybe not as stable as our current fiat money system did, but good enough that we were using it as our standard of value. We were using, gold and IOUs for gold as our money tokens in our economy and passing them back and forth, all of that kind of stuff. So ultimately, there's this kind of implicit promise behind gold as well. Gold is just a token that you can redeem for a certain amount of goods and services from the economy. Now, who is making the promise there? Whose debt is that? Now it's even more abstract because really the society as a whole chose gold as their standard, or maybe the government had a hand in it as well. But generally speaking, by choosing it as our standard, we're kind of promising to ourselves that its purchasing power is going to remain stable. valuable. So you could even go further and say that gold itself, when being used as the base money of the economy, is still kind of a form of debt. But certainly it's true that our base money is a form of debt. It's issued by an institution, and that institution is making a very specific promise about that liability. So let's go back to the article. Why don't consumers and businesses just pay down their debt? For two reasons. First, most of them simply can't. If they had the resources to pay debt down, they wouldn't have incurred the debt in the first place. But the second reason is more important. If consumers and businesses paid down debt en masse, it would crush the economy. That's because the dollars used to pay the debt down would largely be funded by a reduction in spending. So I want to draw a distinction here between paying debt back, which you always have to do, and paying debt down, which is reducing the total amount of debt. So this is kind of what I was getting at earlier, where you can have debt growing and growing and growing in the economy. That doesn't mean you're not paying it back. You're paying each liability back as it comes due, but the total volume of debt keeps expanding. And if you allow that to happen, and if everyone understands that that's going to happen forever, then you don't necessarily have a problem. The only problem you might have is if you do too much of it, or if you do it too fast, then you get too much spending and you get inflation or something like that. Let's see, let's go to Derek.
Yeah, what happens if you get really good at paying your debt? Well, your credit gets expanded, right? So now you can take on more debt. And maybe that sounds a little crazy, but it also makes sense. I mean, you've demonstrated that you're a reliable risk and a good bet, that is, and you can make the payments, and then you get the advantage of having more debt, more responsible use of debt, and all of that can be useful. The missing thing in everybody's equation is the income, because it's that person's income that makes them a reliable debt payer. If you cut off the income source, I mean, in most cases, that's going to interfere with someone's ability to play that game, to sort of like, get a healthy amount of leverage. And so, the income thing is really neglected here. And he mentions that first point, like, oh, well, yeah, they wouldn't need to have so much debt in the first place if they could pay it off, right? And then goes on, and I kind of want him to go back and think about that, like, well, if they had the money.
Yeah, I think that's right. The fact that you have so much debt is not necessarily a sign that you can't pay it back. You might just be lining up your promises with people's commitments to you, and that could like you were saying earlier, Derek. You could be really rich and have a lot of debt, but also have a lot of money coming in, and it's just kind of facilitating the payment system rather than necessarily kind of funding an investment or funding like your own livelihood or something like that. So there's lots of reasons for lots of debt. And this reminds me that, the accumulation of debt is maybe inevitable as the economy needs more and more money, but it doesn't have to be necessarily private debt. Let's go to Bethany.
Hey, I had a question. You were talking about how debt could build up, and if people expect that, it's okay. But we've also talked about that becoming the economy becoming fragile, or the sort of the debts becoming fragile when there are too many of them, and that potentially creating a collapse. So I wondered if you could reconcile those two things.
Yeah, so that's the private debt versus public debt. If the public debt keeps accumulating, that doesn't cause a problem. And even if the private debt keeps accumulating, it doesn't necessarily cause the problem that Richard Vague is talking about, where you have this debt overhang and people can't spend. Well, if you just accumulate more debt faster, that gets rid of that problem, right? If you just keep accelerating the growth of debt, you're not going to have that problem. But what you will have is the problem of instability, where debts will accumulate on each other, and more people's spending will depend on money that's owed to them, and then they owe money to other people, and you get this kind of interlocking web of debt that becomes more fragile and eventually collapses on itself. If the accelerating debt is all on the government's balance sheet, is all on the balance sheet of the Fed and the Treasury, then you don't have that problem because it's only one borrower, right? It's not this interlocking network that grows more fragile. So the idea would be in a healthy economy, you'd want to keep the level of private debt low and steady, and you'd want the public debt, the government debt, to grow and grow and grow and grow. I hope that makes sense. So let's get to another quote from the article. Historians sometimes refer to it as a jubilee, a term used for household debt forgiveness decrees in ancient Israel that were similar to debt forgiveness in ancient Egypt, Babylon, and elsewhere. The widespread existence of this type of debt forgiveness in antiquity profoundly attests to the universality and persistence of this debt accumulation issue. Whether called restructuring, forgiveness, or jubilee, it is the only feasible way to reduce private sector debt when it accumulates to crushing levels in societies, and the only way to do so without severely damaging the economy. So an interesting thought here is there such a thing as crushing levels of debt in society? And I think there isn't, as long as the debt can keep growing. If you have this assumption that there's a limit to how far the debt can go, then you stop allowing it to grow, and then you get these debt overhangs, and that actually triggers the collapse of the unstable structure. But in terms of this, there's no, like, the economy can keep going and going and going, and maybe it gets brittle and collapses because you're doing it all on private sector debt. But there's no such thing as like a crushing amount of debt. There can be a crushing buildup of interrelated and interlocking debt obligations that eventually falls apart. But the amount of debt can keep growing forever, and I don't think that's going to end up being a problem. So let's go to Austin.
Hey, look, I want to jump back a little bit, but then bring it back around to what you just said. Before we were saying about whether banks create money or whether that's borrowers and savers, they're acting as an intermediary. And it seemed to me like you're saying that's the same thing, but I don't think it is, because you're not swapping debt with the saver, right? You're swapping debt with the bank. And there's a difference between whether I'm swapping debt with someone who's dug up gold and put it in a bank, and then and they don't want to spend that gold, so I'm spending it for them, or whether the idea is now that, okay, reserves are that gold, but in practice, what happens is, this is my understanding, is the banks make the loans, then say to the Federal Reserve, hey, we need this much to back it up. So it is more like a money factory and less like a matchmaking service in that regard, to the extent that a friend of mine who's interested in this stuff actually says he doesn't think that banks should be where we keep our savings accounts. The government should have savings accounts, and banks should just do the lending, right? They should only be lenders. They shouldn't be where you deposit your cash, that you deposit your paycheck, right? And so they'd just be money lenders, just be loan sharks, not be vaults for us to keep money in as well. And there would be no problem separating those two functions. And I think that's then you have these government accounts, which could also be where the basic income goes, and they're just identical to your social security number, or what we call a tax file number, right? Everyone gets one by default. The issue with increasing debt and whether we can just increase forever is kind of relevant to that as well, because what Steve Keen would say is that it's not just the debt increases, it's that the rate at which it increases has to accelerate. And that at some stage, spikes and becomes exponential, and that sort of means that you've got this problem where it's going up at such a phenomenal rate that it actually would, I guess, affect price stability, because it's disconnected from what So you don't want to wake up one day and find out that that if debt is an obligation or whatever, like that, the amount has doubled overnight, and then doubled again the next day, and then doubled again, every 2 hours, and then doubled every minute. It starts to become unmanageable and even, not computable at some stage, right? So like I kind of feel like that there's my instinct is that there is a problem when because it's not just the volume, it's the rate at which it increases, and that runs away from us. And so you want some systematic thing to put it down. And also this idea that Derek was saying that, you increase your capacity to borrow when you have good credit. But then the other part of that is income. The third part is, investment. So you're borrowing to invest in something that hopefully increases your ability to pay and increases your income. So if the big borrowers don't just have a static income, they then borrow money and then invest in, factories or productive goods or whatever. And that is what allows them. And that's really what the bank is. And the bank is involved in that a lot of the time. The bank comes and, wants to know what your business plan is and how are you going to use this money in a way that will generate income, or at least, and it's the other thing, generate assets that we can take if you don't pay us back, right? If you build a factory, but then you somehow screw it up, well, at least we'll have the factory that we can come and repossess and sell or whatever. So, I mean, there's just a bit of a few different things at a few different points there.
Yeah, I mean, I think you're bringing in a lot of important concepts, especially the one of collateral. You're borrowing, but you have something that people can take away from you at the end. And at the beginning, you were trying to kind of draw a distinction between saving money you have or assets you have versus saving something you don't have yet. So, maybe I can save, some brick or something, and someone's going to give me a really good rate on it, but I don't have the brick yet. But if someone's offering me a really good rate and I know where to get that brick at a cheaper rate or a cheaper interest rate, I'll be like, okay, I'll borrow this brick over here and save that brick over here. And that's kind of the thing that you're trying to prevent from happening. You're talking about the bank that you were specifically saying that maybe we could prevent banks from doing, which is basically taking money on one end and saving it on the other end, or something like that. I don't think there is, in terms of the mechanics, I don't think there's much of a difference between saving wealth you have and kind of issuing or taking in someone else's liabilities and issuing your own liabilities. I mean, it's all, you're still swapping. Well, let's see, if you just have a pile of cash and you want to put it in the bank, are you swapping an IOU? I guess you're just depositing it in the bank and the bank is giving you an IOU. So there's no swap of IOUs there. You don't owe the bank anything. The bank owes you something because you gave them all the cash. So maybe that's what you're trying to separate out. I still don't know how much it makes sense to separate out those things. I do think there's a case to be made for having the government run the payment system more directly and just have it be the default place where you park your deposits. And then the reason why you would ever deposit in a bank or save in a bank or lend to a bank, is another way of putting it, is that they're paying you a better rate than you can get from the government or something like that. So you could certainly imagine it being structured like that. Let's go to Bethany.
Hi. So I was wondering, you were talking a minute ago about debt piling up and the sort of historical need to have jubilees. I guess I was wondering if you could reconcile kind of the debt piling up on an individual level and the consequences of that with this bigger scale, because it seems like on an individual level, if I can borrow more to cover more debts, I can do that, but maybe it still works out the same. It just seems like I'm paying more and more interest, and it's not clear to me that works out for like a private individual person, even if my ability to collect debt is accelerating. Maybe you can help me think about that more clearly.
Yeah, I mean, so Austin was mentioning, that it could go exponential, and I would just point out that exponential means you're doubling at the same rate every day. So what he was describing, where it doubled one day and then it doubled twice the next, like that's a super exponential thing. And I think generally speaking, if you're paying interest is an exponential thing on its own. If the interest rate keeps going up and up and up, then you're paying more and more interest, and you're paying at a higher rate. But at the level of the individual, I mean, yeah, if your capacity to borrow keeps going up, if you can keep borrowing more and more, there's no reason why you can't keep that up forever, rolling over your existing debt and adding more and more debt. We talk about, the government being able to do this, like they can borrow forever and their deficits can run forever. But if a household or a business has enough credit, or if we create the conditions such that a household or a business, or households and businesses as a whole, have enough credit, the private sector can do that too. The problem is with the fact that it's all these different lenders and all these different borrowers who are depending on each other. And that's why it becomes more brittle. But the government is not fundamentally different from households in this way. It's just a really big household. It's got its own really big bank, and it's all one borrower. So I think that's the main thing. That's what makes it stable. And you could look at the ancient societies historically, where their debt is building up, and maybe they could have solved this problem by having more centralized money issuers who are able to kind of absorb that growth of debt in their economy instead of having to keep going through this cycle. But I think they often didn't develop that, or actually I'm not a historian, so I won't speak to why they didn't figure this out a long time ago. But fiat money, I guess there has been fiat money throughout history, but it's always been kind of in parallel with gold-based money and other commodity-based monies that people are trading more kind of internationally or between different economies and stuff like that. It's only recently that we've had a fiat-based global currency. I don't know how much of a difference that makes, but the more you have a centralized institution that can absorb the growth of debt, then you can call that public debt, and that's a lot more stable. Let's go to Derek.
Yeah, I mean, maybe I want to try to sort of frame this in a different way for Austin, because Austin, you mentioned that you were saying the problem is we don't want the private debt to grow too fast, right? I mean, too much, too fast, but there's an important distinction there. But I mean, I would say actually the problem is that the private debt can't grow as fast or as much as we need it to, and we're trying to do that, right? So Alex was talking a second ago about we can create the conditions for private debt to sort of roll over, and that's what I think maybe wasn't addressed, at least in the article, at least as much as I remember it, which is that we're making debt as cheap as possible. So the fact that we have all of this private debt, it's like, well, that's we could decide not to do that. If we wanted there to be less private debt, you could make private debt more expensive. So I mean, I think the framing of this is like, if you think about it from an MMT perspective, or a lot of the heterodox schools these days, everyone's sort of coming to agreement that okay, there's excess potential we're not taking advantage of, and we're not doing that because we're not doing it because the government isn't issuing the promises that the economy needs. We're not promising as many goods as we could be. So we've been trying to step on the private debt lever, and it does like a reasonable substitute, right? Like if you get every private actor in the economy, if you make it easier for them to issue debts and create money, you can grow the economy that way. It's just that it keeps people unnecessarily poor, and it creates this spider web of debt problem that Alex is talking about, where so many people have all of these debt connections, and you're just multiplying all of those. It turns out it's easier to more debt is one of those things that's actually easier to centralize, because we can use monetary policy to make the debt sustainable, and that's what controlling the general price level means. And so, I mean, there's different ways of framing it, but this is the advantage, I guess. This is the advantage of looking at all the money as debt, is because it allows us to say that, like, well, no, we can sort of offload this burden from the private sector to the public sector, and that'll end up having more stable growth of this debt in a more stable way. And I mean, one just interesting consequence of that, or thought experiment, is like, we're saying, okay, the government maybe should be the ones where people store their money. And, remember, people store their money at the bank because it feels reliable. And I would argue that, whoever pays out the basic income, probably whatever account that basic income goes into, sooner or later, that's probably going to be the account that people use, right? It's going to be more convenient to just have the accounts there. And it shows that, like, the reason why people would be using that account, trusting that institutions, and actually opening the basic income account is because they trust that institution, like the Federal Reserve, to treat the basic income like a debt, to take it seriously, and to make sure that that debt is redeemable by the economy. And that's actually why they would start using it as a basic income. Any of one of us today could try to start paying out a basic income to everybody we meet. No one would accept it, because we're not that good at managing our debt, and the central bank, the Federal Reserve, is.
Yeah, I think that's right. I mean, we could fraudulently try to pay out a counterfeit basic income, and they might trust that because they think it's a liability of the Fed or just as good. But if we tried to pay out a basic income in little notes that say, Derek Van Gorder owes you $10, that's not going to get you very far. If you admit that's what you're doing. I think those are good points. Let's get to two more quotes from the article. From 1950 to 1980, US government debt to GDP did indeed fall from 86% to 32%, but that was only possible because of a massive re-leveraging increase in debt in the private sector, where private debt vaulted from 55% to 101% of GDP. Without that massive private sector debt growth, the improvement in government debt would not have occurred. This was more of a trade-off that is best understood as the debt version of out of one pocket and into the other. The converse happens as well. Private debt deleveraging generally only occurs when accompanied by massive public debt growth, as in Japan after its 1990s crisis. So this idea, I think that Austin mentioned, that we're all becoming Japan now, that seems like the healthy thing. They're shifting their debt into stable public debt away from unstable private debt. And then the 1950 to 1980 thing feels like increasing stability, because instead of expanding the public debt, you're expanding the private debt. So let's go to the next one. Oops. It's a fact that gets little attention. The government does not print money out of thin air as if it is free money that comes out of nowhere, even though this allegation has been repeated so many times that it has seeped into popular consciousness. Instead, money is created by debt. Essentially, all money creation comes only with the simultaneous creation of debt. So I think this is starting to get into the Jeff Crocker stuff. Like, he imagines the money being created and then the debt is also created at the same time, or something like that. Whereas I would say that the money is the debt. The government spends this liability into the economy. That's an IOU from the government. And then that can be transformed into other forms of debt, other forms of government debt. When the government issues a treasury security, I guess the two things that do happen at the same time is they spend money and they issue the treasury security. So you could tell a story about how the treasury security is the thing that's created, or you could tell the story about how the money is the thing that's created. But when you issue the treasury security, they're trading it for regular money in the economy. They're trading it for base money. So the treasury security gets issued, it's replacing base money in the economy, and then the government is spending base money in the economy. So somewhere out of that whole mess, I mean, you can do it on balance sheets and it makes sense. New money has been spent into the economy. Whether you want to say the treasury security is the new money or the money is the new money, the debt is the money. It's the same thing. The creation of money is the creation of debt at the level of the government. So I think that's just something important to just keep in mind. Let's go to Richard.
Oh, there's another reason to, put your money in a bank. It provides a surface, like keeping it safer. Wherever you're keeping the money, if it burns down or something, then there's no evidence that you had the money there in the first place. Or if you're like a business, you need a Brinks armored truck or whatever to come and get it and then bring it to a bank or something. And there's also back with the first transnational bank was the Knights Templar, where they would take your money into their coffers and then they stamp it, and then they would take a certain percentage of it. So when you went over to another branch, they would give you that much back, a certain amount back or whatever. So it'd be safer than hiring a bunch of having the Middle Ages version of a Brinks van with all these guards around it and stuff.
Yeah, I mean, there's certainly more secure ways to represent your money and your wealth, and there's less secure ways. So certainly, banks initially, a big part of the service they provided was that you don't have to buy a big vault armed guards to protect your wealth or whatever. But because of that convenience that they provide you, that also gives them a lot to work with in terms of being able to lend and create deposits, and it kind of bootstraps this whole business of I guess a question you could ask is, if money were all digital, would banks have emerged in the same way, since they kind of emerged providing safety for people's assets? If it was all digital and all secure, what would the role of banks be? And I think the main role of banks would be to pay people to deposit money. So banks originally emerged and they were seen as the ones providing the service. So you might even pay to have a deposit at the bank. But I think as money gets more secure and they no longer provide that service, now you're providing a service to the bank, and the bank is going to be paying you for that. So that's why you see interest on bank accounts more these days and that kind of thing. At least that's kind of my way of thinking about it. But I think you still would have banks, because there would be this opportunity to profit through lending and such. Let's go to the next quote from the article. Here we go. But what if there were a way for the government to create money without simultaneously creating a commensurate amount of debt? There is. And I'm going to, spoiler alert, say that no, there isn't. That is not a thing that is possible. I know what he's describing in the article, and he's kind of framing it as money that's debt free, but it has the same properties. Like, it has the same effects. He's not getting around what would happen if the amount of debt, in at least the amount of public sector debt in the economy, increased. Let's go to. I was going to go to Austin, but let's go to Bethany. Or let's go to Austin. Austin, here we go. You lowered your hand there for a second.
Yeah, I was going to drop this, but he's brought it up again. So I kind of feel like, I'm going to say the thing that economists always say to each other when they're being mean. I feel like there's a little bit of hand waving going on here. I feel like you're abstracting out one level too much when you talk about whether the saving, so before we were talking about whether there's an interaction between a saver and a borrower via a bank, right? And whether my deposit affects your ability to borrow from the bank, I think that really matters. And I feel like you're saying that it doesn't. And I also feel like you're ignoring the gap between when they create a treasury bond or some other kind of asset that someone owns at the same time as they create money, that affects doing that, again and again and again throughout the economy affects the way things work, and the constant increase of debt matters, and it all matters because of interest payments. So if the amount of debt is growing at an exponential amount, then the amount that people have to pay in interest is growing as well, right? So that means wages and prices and everything else have to keep up. And if that's growing exponentially or super exponentially or whatever, then you've lost the ability for price stability, right? Because you've got to have the amount that's coming in to your bank account gets swallowed up by the amount the amount that's going into people, the amount that people have access to will be swallowed up by the amount that they owe to the financial sector or to very wealthy people. Just count very wealthy people, the kind of people who own treasury bonds, and the financial sector is one group, right? Then you have this constant transfer, this constant increase in the amount that people have to pay into the financial sector, right? And that there's nowhere for that to come from, because every time you create another loan to pay that, you're incurring you're expanding the amount that has to be paid. So I feel like this idea of there needs to be a release on that system, because otherwise, and this is what Croc is saying, what he's saying, what Steve Keen is saying with the debt jubilee. What they're all worried about is the financial sector kind of eating the real economy, and what we're looking for here is an escape valve for that pressure, or a way of paying off all that interest, right? Because like I said before, what you owe the bank grows faster than what the bank owes you, right? So you owe the bank $102. It owes you 101. The next day you owe the bank 103, right? And it's what is owed to the financial sector runs away from the ability of the real economy to pay, unless some money comes from somewhere to make up that gap, right? And that's what I think Crocker and Keene and this author are all looking for. And I mean, I think your answer would be, well, the Federal Reserve is already doing that. And to the extent that it's, if it's just creating money that is owed between one part of the government and the other, then that's like the closest thing to debt-free money, because it's not, there's no real, the central bank isn't worried that the Treasury is not going to pay it back. It can just, and that's the spot where I guess it doesn't matter how much. They can just keep lending out more money in ever greater numbers, and to cover the interest and the loans, to cover the interest and the principal of the previous one, right? But in the real economy, that would mean all the volume of trade and the prices of real things wouldn't be able to keep up with, would have to be constantly where's this, or would they be deflationary? But like, where's the space coming for that? Yeah, that's it. It would be deflationary, right? Because where's the space coming from for us to pay back these ever increasing interest payments? It has to come out of spending capacity. And so everyone's trying to create more spending capacity without creating more interest payments and more debt. And I think that matters. Like, it seems like it must, right?
Yeah, so I get what you're saying, and I also get why you kind of went back and forth between inflationary and deflationary, because if we think about more and more money having to be created, that feels like an inflationary effect, and there's more and more money being paid into the economy, et cetera, or the financial sector is growing and growing and growing. But then the fact that people have to pay more and more interest to the private financial sector, that pulls away from their, or takes away from their spending capacity in their day-to-day lives. So that feels like a deflationary effect. And my answer to that question, or this kind of dilemma, is that there's a balance to be had between those two things, right? And you can make sure that the level of borrowing is enough to sustain consumer spending, and also be able to pay the interest rates. But that, I'm not going to say that there isn't a huge problem with private sector debt. There is a huge problem with private sector debt, and it does get unwieldy and unmanageable as it grows. And the solution to that is to have more public sector debt. So basic income, for example, the government just spends new money into the economy, and that's a form of public sector debt. And then that makes it so that private actors in the economy don't have to borrow as much, because they're getting this free money from the government that is funded by government borrowing. And I think this point is a good segue actually into the next quote from the article. So Richard Vague describes this idea of creating a non-debt government issued security called a perpetual. It pays no interest and it never has to be paid back. So that's just a little background for this quote. So perpetuals would be a way to create money without creating debt, at least in the sense of debt that pays interest and has a maturity. That is a key and profound difference. It would improve the ratio of GDP to government debt that does pay interest and have a maturity. It would obviate talk of burdening future generations with this debt. Because of these characteristics, I think that perpetuals could more appropriately be referred to as printing money, just as this was the appropriate characterization of the greenbacks authorized by the Legal Tender Acts. So I'm going to say that there is no profound difference here. If you're issuing Treasury securities at an interest rate of 0 that can be rolled over forever, that's exactly the same thing as a perpetual. If you're keeping interest rates low on the government debt, then that's the same as a perpetual. But if you if you want to ever tighten monetary policy, you're going to have to raise interest rates. If you ever get to a point where you want to rein in the financial sector, you want to prevent there from being more private sector lending, you want to rein in interest rates. So if you're flooding the economy with perpetuals, he talks about, oh, well, maybe only some of the government borrowing can be in the form of perpetuals and that kind of thing. You'd want to keep it to a reasonable amount or something like that. But to the extent that you're doing that, you're just creating more zero interest government debt, which is essentially the same thing as a normal dollar, right? A dollar is, I guess it's redeemable on demand for another dollar, but that's the same thing as not being redeemable at all. It's worth whatever its face value is. It pays no interest. It's just like you're printing base money. He's right about that part. It's just like you're printing base money, but so is doing it through treasuries, right? It's no different. And ultimately, for monetary policy purposes, to keep the purchasing power of the currency stable, you're going to need interest rates in the private financial sector to be at a certain level. And if you're forcing perpetuals to be always at zero, then you're taking one tool out of the toolbox that allows you to get interest rates to where you want them. Let's go to Bethany.
Hey, so I had a few things. One based on that point is just, it does seem like there's a public understanding issue and maybe a political understanding issue too around this. So even though it may actually be a better system to do it the way we do now, it seems to be confusing people quite a bit because many people believe it really does push a burden off to the future. And many people are very concerned about that. So it seems like something that could be done rhetorically or semantically that would help with that might be actually extremely valuable. The other points I had, second point was that one advantage, of course, of public debt over private debt, I think, unless maybe someone mentioned this, but private debt is for profit. And so it leaves out a whole bunch of people who are like less likely to be able to pay it back with interest, right? So it's not reaching everybody. And that's a really big, important difference we've talked about in this group before. And then the third thing I want to mention was just, I found it interesting, the sort of thought process that he goes through, and maybe others have gone through, where it's like, okay, we need to grant a debt jubilee, but then wait, that's incentivizing people to go into debt and leaving out the other people who didn't go into debt. So now we just actually give people money and then they can use it to pay back the debt. It's like an interesting roundabout justification for something like a basic income. And it reminded me of some of the actual proposals we read about a few weeks ago, such as like the carbon tax, where you then like compensate with people with cash to sort of deal with the costs. Sort of these ways of getting at giving people cash that are justified in some way that's more familiar, I guess. It just sort of speaks to how unfamiliar it is to just decide to give people money for the kinds of reasons that we tend to talk about in here, that you sort of end up at it through these other angles. And this is another example of that as well.
Yeah, I think that's right. And it's interesting because a lot of what he says in here is right, and the things he's proposing will work, but not for the reasons that he says, just basically for the reasons that they're equivalent to the kinds of things we would normally do when we deficit spend. And he's kind of like trying to avoid that whole area because I think he doesn't necessarily understand that's what he's doing, that he's doing something that's equivalent to deficit spending, or proposing something that's equivalent to deficit spending. So let's go to the article again. Here we go. This notion of inflation caused by money supply or debt is one of the great red herrings of economics. The fact that other things being equal, the fact is that other things being equal, high levels of debt are disinflationary, even deflationary, because they suppress consumption and investment, and thus weaken aggregate demand. So I think this is basically what Austin was getting at before. And it's not that high levels of debt on their own are disinflationary. It's that if you're not allowing debt to keep growing, then you have this disinflationary problem where there's a debt overhang and people are having to pay their money back. If the debt levels are high and you're allowing the debt to keep growing, you have no disinflationary problem. And if you let it grow too fast, then you have an inflationary problem. So I think that's important to pay attention to. Let's go back to Austin.
I just wanted to say, okay, I feel like this is relevant as well. Like, the government debt to the federal bank doesn't matter, but surely government debt to other actors like financial sector people or bondholders does matter, because then the interest that they pay on that debt allocates spending power in the economy. And this is what I was talking about with the financial sector taking over the world. That, you know, there's the government is when it makes an interest payment to those people, it's saying, okay, these people now have an ever greater claim on the real resources of the economy, and that crowds out other people. So I feel like it's not identical. Once the Federal Reserve buys the bond, it becomes identical to money creation. But surely, in the interim, while it's in the hands of like real actors in the economy, then it's not identical.
Right. So the question is, why do you ever want to let it into the hands of people in the economy? And the answer is that you want to influence interest rates in the private financial sector. So the MMT story is often that the interest on Treasury securities is going to rich people and therefore, you know, making them richer and creating inequality and that kind of stuff. And, you know, that's kind of true to some extent, but most actors in the financial sector are making money by borrowing and then lending again. Like we were talking about before. And when the rate that you can get by lending to the government is higher than the rate you can get by lending into the private financial sector, that reduces the total volume of lending and borrowing in the private financial sector. It reduces the amount of money creation in the private financial sector. So the main effect, so if all you're doing is looking at flows of money going into the private sector or back to the government, then it looks like you're doing something inflationary. You're expanding the money supply, and you know, now there's more money kind of in the economy, that kind of thing. But really what those payments are doing is they're paying people not to create money. They're paying financial institutions and banks and investors, et cetera, saying, hey, you know, give the money, lend to the government instead of the private sector. You're not going to lend to the private sector for a rate that's below what you can get from the government. So that's why they do it. That's why the government borrows. And even if the government were not issuing Treasury securities, you'd still kind of like what I was saying during the sovereign money discussion, you'd still have to end up in a situation where the central bank needs to get monetary policy where they want it. So if the government is just spending money and not issuing Treasury securities, then the Fed has to figure out something to do that's equivalent to issuing interest-paying Treasury securities onto the market. And something they're doing right now is actually they're actually doing this. They were until the coronavirus crisis. They were paying interest on bank reserves to the banks, and that's very much the same as the government paying interest on Treasury securities in terms of the effect on the private economy. So I'm going to go to one last quote, and then we will go around and get people's final thoughts. Here we go. Furthermore, central banks have shown over the last decade that they may not even know how to create inflation. Even though they have employed the methods widely thought to cause high inflation, including low rates, high money supply growth, and massive deficit spending, inflation is running below the central bank's target. So this is absolutely wrong. Central banks do know how to create inflation. They can flood the economy with money. They can make lending even easier than it already is. You know, there's lots of ways to create inflation. This is not a problem. Yes, it might be true that inflation is running below the central bank's stated target, but that's because they're being cautious and they don't want to go too high. And, you know, there are various reasons for that. Some people say they say it's this target, but they're actually trying to keep it below that. That's like the ceiling or something like that. I mean, there's lots of reasons why inflation is running below the central bank stated target. It doesn't mean they don't know how to create inflation. Of course, they know how to create inflation. They can always create as much inflation as they wanted if they really wanted to. That's not a problem at all. So let's go around and get people's final thoughts. We will start with Derek, and then we'll go to Richard, and then Neil.
I mean, just a meta note first. I mean, this time I think we got into a lot of the quotes of the article, which is great. I mean, I understand that probably comes at a cost of all of us getting to comment, but I do like that we got really into the article because this was a real doozy, this one. So, I mean, I think that how I've come to look at basic income and money in general is it's kind of a recognition that we are all in each other's debt in a way. And it's because these promises are kept and it sort of works in aggregate, then money still works and we can redeem it with things. We're keeping our promises collectively to each other. What's not true is that every single individual person, needs to be on both ends of that. If the government is making a promise on behalf of people who don't really have anything to wager in the stakes of the economy at present, then that can be okay. And there's no reason that can't work sort of in aggregate. So I have started to just look at money itself as what we call public sector debt. And I think there is something to this idea that maybe, the printed money or created money is just a 0%, interest paying piece of government debt, whereas we have the other forms of government debt as policy tools, right? As part of our arsenal to keep public sector debt at the composition and the size that we need it to be for the current economy. So, I mean, my simple summary would just be like, it is true. I think Bethany's point is really, really good, which is that like calling it public sector debt has created a problem for a lot of people, and we're looking at it wrong. And there's two ways out of that. I mean, one way is just we could just sort of nominally say, okay, we're creating new money, and maybe that'll make people feel better. The other thing is to say that maybe that's not so scary. Maybe it's okay that we have this thing called money, and it's a promise we keep rolling over, basically. And maybe that's okay. Maybe it's okay that we can make good on these promises for everyone in just a better way than we're doing today.
Good stuff. Let's go to Richard, Neil, and then Joan.
The way I see it is that money is meant to better the lives of those who have it, and that when the government spends money, it's to promote the welfare of everyone, including the people who don't have it on their own. And that if the government gives someone a basic income, it believes that they can figure out how to improve their own lives without someone dictating to them what to do.
Yeah, I think that's right. And just keeping in mind that basic income is government debt. Instead of forcing people to borrow and kind of borrow responsibly, you're recognizing that it's a macroeconomic thing. It's not a problem at the level of the individual, and we shouldn't really be. It doesn't really make sense to treat it that way. Let's go to Neil, Joan, and then Elizabeth.
I disagree with your last point. The Federal Reserve always says that you owe this money when it sends out a bond, unless you want negative interest rates, and that wouldn't work too good. And so they've been trying to increase inflation by all sorts of ways. But if nobody wants to borrow the money to use it for some purpose, it won't work. Now, so they put out money and say, I don't need the money. I'm not going to build a plant. What am I going to do? Okay. So that's one of the reasons why I came to the basic income idea in the first place. The Federal Reserve is desperately trying to increase inflation. I look at it desperately, and they haven't been able to do it.
Yeah. I don't really see the Federal Reserve as being desperate, but what you're bringing up is kind of the John Maynard Keynes pushing on a string thing. Like you
right,
can't,
exactly.
Yeah. And I think that's true to some extent. You can't make people borrow, but there are things they can do. They can backstop more markets. They can buy more different kinds of assets, and they have. And my sense is that we're not even close to reaching the limit of that. Can they fix the economy entirely? No, because they have no mechanism to make sure that money is distributed to everyone. They really only work through the financial sector. So there are limits to what they can do, but I don't think they're going to have a problem.
I disagree. Okay, so we disagree. Good enough.
Fair enough. Okay, let's go to Joan, Elizabeth, and then Eddie. Go ahead, Joan. Yeah.
Sorry, what was the question?
Final thoughts.
Wait a minute, my speaker is low.
The question is, what are your final thoughts on Debt Jubilee or any of the stuff we've been talking about?
Okay, yeah. Go ahead.
So go ahead. What are your final thoughts?
Okay. I just want to thank you. I listened and learned as usual. Thanks, Alex, and everybody.
Okay, great. Let's go to Elizabeth, Eddie, and then Austin.
I appreciated the point that I think Derek brought up pretty early on about how the issue isn't debt per se, but people's ability to pay back the debt. And so if you sort of, when we got really in the weeds around like all this stuff around debt and sort of reflection on it, I was like, okay, like I know it matters, but part of me is like, okay, but does it really matter that it feels, which, and it sort of reminded, I was like, all right, this is the thing that Alex talks about all the time of how like the economy is supposed to be like a prosperity machine. It's like, okay, like, you know, people can, you know, consumers can get stuff out of the economy. And so if people are going into debt to get stuff out of the economy, like that's fine, so long as it doesn't like mess them up later on, where it's like, oh, I went into debt to like, you know, do this thing and now I can't pay it back. And so now I can't like provide for myself. And so it's interesting sort of reflecting back and being like, okay, wow, so we like really came full circle. It's like, okay, yeah, so basic income is really the solution. Here it was not, I wasn't quite expecting to circle back with that directly until I was reflecting on the conversation.
Yeah, rather than having consumers go into debt, you just have the government go into debt, and that's basic income. Let's go Eddie, Austin, and then Bethany.
So with regard to the debt jubilee, I think that there are a couple of very fundamental questions that we can ask here, which are very instructive. The first question is that, especially if we frame the debt as this, all debt is an asset. So this is also an asset, and we say, apparently the lending in the economy, people lending their money to other people is just growing and growing and growing. There's, more and more and more of it. Why exactly is that a problem? And if we take it back to the ancient debt jubilee, I think that's very instructive, because that ancient society is a fixed carrying capacity society. There's only a certain amount of production that you get out of their land, which they're using to graze livestock on. And I think it's genius that they came up with this solution, because if you think about how that system evolves, if you don't have the debt jubilee, and you have lending and borrowing with an economy that does not grow, there's no real investment possible to increase production here. What you end up is a positive feedback loop, where the people who are lending to other people, they're going to increase their net worth through the interest. And the people who end up borrowing from other people, they're going to decrease their net worth by paying out interest. And there's no increase in productivity or production. What you end up with is the origin of classes in society. You end up with one group of people that gets richer and richer, and one group of people that gets poorer and poorer. And so the debt jubilee is just genius, because if you say, every 50 years, all of that goes away, all the debts are canceled, then, the lenders say, okay, well, if that's the case, I better stop lending, and the problem goes away. To bring it back to modern society, I think that debt here, I think the best analogy here is one of like if you're explaining a fire or explaining combustion. This is a bit of a jump, so just bear with me. So if a house gets on fire, there's multiple ways to explain this occurring. And so one of the explanations that you could say is that this is chemical combustion. The molecules in the wood of one area of the house has gotten hot enough. It combines with oxygen that releases a lot of heat. It gets much hotter, and it makes the neighboring molecules also get hotter and also do the same thing. So it's a positive feedback loop. So this is why the house is on fire, because of oxidation reactions, which are spreading in a positive feedback manner. That's one explanation, and that is a correct explanation. But on another level, that's also a bit of a silly explanation, because you could say the explanation is that there was a candle in the kitchen, it fell over, and the paper towels caught on fire, and that's why the house, it goes up in flames. So I think that one of the really important things here is that the problem occurs at between the borrower and the lender. The problem occurs at the location of the borrower. The borrower having trouble paying back the loan and paying back the interest, despite the fact that we have productivity in the modern society, and many of these borrowers are companies. And so what it looks like to me is that we have a problem in society with underconsumption. And so when you have underconsumption, the consumer cannot consume enough. The businesses have trouble making enough profit to justify the investment in real assets. So a healthy way would be the business borrows money. There's interest that they're going to pay, but that's fine because they're building a factory, and that's going to pay for the interest on the loan. But the problem occurs when you have underconsumption, and the factory is not going to, be able to sell what it's producing. So as a result, as Neil pointed out, the business starts saying, these factories, it doesn't make sense to build them. So you may be lending at 1% interest. I don't want the loan because I can't find anything to invest it in. Yeah.
So I think what you're getting
yeah.
at is what's called proximate and ultimate causation. So the example with the fire is that, it's the combustion of the molecules moving or whatever, but, ultimately it was a candle that fell over that caused it. And it's the same thing with the business investment, right? You are, the business is not investing and that's causing some problems, but you don't blame the business for not investing. You blame the fact that there's nothing to invest in. There's no consumers who are gonna activate the capacity that the business builds. Let's go to Austin and then Bethany.
Okay. Going back to the last quote, I think this is an interesting place to sort of all the different threads kind of intersect there a little bit. This idea and this idea that the central bank can't create inflation or can't fight deflation. If it's actually got its hands tied, then we've got a more serious problem, because it's not just that it can't hit its inflationary targets; it's that we might actually go into a deflationary, Great Depressionary spiral, right? And I tend to agree with Neil that no, the central bank can't do it, because at least it can't, as long as it does like traditional sort of strict monetary stuff, because then it's only interacting with the financial sector. It's only interacting with investors and borrowers and investors and banks and blah blah blah. And it's not interacting, it's not putting money in the hands of consumers who would then make claims on the real productive capacity of the economy. Inflation comes when spending in the real economy, like price inflation of goods, comes when spending in the real economy starts to approach the capacity of the economy to output, right? So I know that...
No.
Did I say it backwards?
No, you didn't say it backwards. That's not the answer. Inflation, it's not when, that will cause inflation if spending gets to the capacity of the economy. You can have inflation when we're way, 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 way below capacity. It's about the slope of the demand curve, right? So you can get prices up and you can have the economy way underproducing, and that's a valid inflation scenario. And that's actually how the central bank achieves inflation. So you're of course right that, generally speaking, they can't get money to consumers in general, but they can pump enough money into the financial sector that the people who are able to spend money are able to prop prices up. And that's how they maintain inflation. I call it anti-competitive inflation because businesses raise their prices instead of producing more.
Okay, well, look, I know that in Australia, we've had the situation where the central bank has even sort of been dropping quiet hints that the government needs to that monetary, like they'll say things like monetary policy is reaching its limits, and we need more fiscal policy, right? And we had things like, as my friend who works in a bank has the same impression and says, look, we can't seem to hit our inflation targets. We have, and he says, the known Bolsheviks at the Business Council of Australia have been calling for an increase in welfare payments, right? Like, because we've got no one to sell to.
Right.
We can't, there's no point in lending to us because we can't go out and open more businesses because we won't have any customers, right? And there's,
Yes.
no matter how rich you are, I mean, this is weird because I know that you're aware of this.
Yes.
This is the point you make in other contexts. No matter how rich you are, you're not going to eat 1 billion hamburgers. You're only going to swim in one swimming pool at a time. You don't need 20 super yachts. You just, you're only going to have one boat that you're actually on at any given moment, right?
Yeah.
So this minority, there's got to be a limit on how much of a demand of this wealthy minority that might have access to the money that the Fed's pumping into the economy. There's a limit to how much they can how much of a claim that they can make on the economy. And what the Fed, anyhow, bringing it back to the Fed and the article and and basic income. See, what I'm a big believer in is that the Fed, the central bank, I actually think the world's central bank, the IMF, should just create accounts for everybody and put money in it, and and worry about the debt that corresponds to that later.
Right.
Worry about creating enough of a demand for that money later through taxes or fees or interest or whatever, right?
Yep.
So I think we agree on the actual what to do,
Yes.
even if we don't agree at what happens in the middle.
So I think everything you're saying is right. The only part I would disagree on is the inflation part. And the reason why I can disagree on that and not disagree on the other parts is because a lot of people, they tend to lump the price level and price inflation in with other indicators in the economy, like are we at capacity, or is everyone fully employed, that kind of thing. You can be the Fed can't get the economy to full employment. That's not something they can do. They can't get the economy to full output. That's not something they can do either. They can keep the price level stable. And they can do that with only a tiny portion of consumers spending a lot of money. And those consumers are not claiming more from the economy. They're just jacking up the prices on those things that those consumers actually buy. Because when those rich people have more money, it's profitable to raise prices instead of to produce more, because nobody else has very much money. And the economy is in a lot of trouble, but you're still not having, you're still able to keep the price level up. So the price level can kind of be kept up independent of these other things. Sorry, that was a long digression, but let's go to Bethany for final thoughts.
Yeah, I think you just clarified this, but from the last discussion, it would be like raising the price of hamburgers. Not that the richer people are going to eat more hamburgers, but the price of the hamburgers they eat just goes up instead.
Or you just prop it up, you prevent it from falling. Yeah,
prop it from falling. My only last thought is now after this discussion in particular, I'm curious to know more about the historical examples and when they had debt jubilees, what actually happened. Were they predictable? Did people kind of plan for them, and how did they plan for them? And was all debt due right before the jubilee? I don't, it's like curious to me how they would even work. And so obviously that's sort of outside of the scope of this discussion, but it seems like it would be difficult to make work. So anyway, that's my final question or quandary.
Yeah, I think that's a really, really good question, and we could have a debt jubilee part 2, the history or something at some point. So I think some people brought up some really good points throughout and at the end, and one of them is that this idea that the accumulation of debt and the fact that there's one group that gets richer and richer and another group that gets poorer and poorer, that being kind of like the origination of classes. You could also have a world where one group's getting richer and richer and richer and the other group's just fine. And that's a basic income world, right? The people at the bottom don't need to be getting poorer and poorer and poorer. They can have a reasonable economy that's just working and prices are stable and the economy's at full output and everything like that. But you do have these people who are getting richer and richer and richer. And then a question we can ask is, does that cause a problem eventually if the rich people get too rich? And my sense is that there are some potential problems there, especially with instability. If someone's a quintillionaire or something like that, you probably wouldn't want that source of volatility in your economy. So what are the ways to mitigate that? People often suggest taxes. I would sometimes suggest maybe the government should sell things that only rich people can afford. And they don't have to be real things, and you don't want it to be something that the rich people can then sell again, right? Because then you're just transforming their wealth into another form or something like that. But get rich people to want to spend their money, to want to give their money to the government, and I think that's a great way to kind of keep things in check. But that's just some thoughts for the future, not really super related to today's discussion. Next week's topic is the moral framing of basic income. To what extent does it make sense to frame our understanding of basic income in moral terms? And next week we have another big panel of experts. We have 6 people coming in. Bethany is one of them, and Derek is one of them. So looking forward to that. And thanks, everybody.